Welcome to Asset TV's Investment Insight with me, Joanne Bainham. Today I'm joined by Seeiso Matlanyane from Prescient Investment Management. Did I get your name right?
You got it spot on.
Trying my best. We're chatting about portable alpha. That's quite a big word and quite scary. So we're going to discuss that today. So what is it?
Yeah, well, hopefully by the end of this discussion, it's not so scary.
Okay.
Portable alpha, it's a way of managing portfolios that separates the different components of return between sort of your passive market exposure and your active sort of manager skill perspective. So I think investors are becoming aware of the fact that, and it comes through with that systematic investing, Ronald Kahn, building on from that, returns are not simply just, manager says you got 20% return. There's an element of that is just from being in the market. And then there's an element as well that comes from the skill. So what portable alpha allows us is to separate the two components and manage them completely different, but all within one product. So sometimes called alpha transport, sometimes it's called alpha beta separation strategies, but it's a passive market exposure and then overlaid with an active component on top of that or transported on top of it.
Would it be wrong to say it's like passive plus? Would that be wrong? Is it using portable alpha to give you passive plus something more? Is that what you're trying to do?
Exactly. I wouldn't say that's wrong. I think it's exactly what the outcome is.
Okay.
In the sense that yes, you will get a passive market exposure, but then instead of just getting that market exposure, there's an active component as well, which adds a little bit plus. So we've heard terms like outperformance type structures, index plus type structures. The portable alpha, nomenclature is right within that gambit.
Okay, and because the problem with passive investing is you're always going to get less than the passive by the mere fact that you're having to pay fees.
Correct.
And we're not even talking about trying to replicate the index. Just the
Yes.
fee alone will mean you will never achieve what the index has done.
Correct.
So is this trying to help with that problem?
Correct.
Okay.
And take it further. But you're absolutely right in the sense that one of the big sort of attraction points of this type of strategy is that on top of getting just pure market exposure, as you would with a tracker ETF, you're right in that the tracker ETF has no objective to try and generate outperformance, but it has this headwind of costs and fees. So even if a pure passive tracking manager had the perfect systems and did everything right, dealt with the corporate actions, dealt with any sort of inflows and outflows perfectly, their bed is made in the sense that they're going to underperform because they have this fee headwind. An index is a spreadsheet exercise, right, provided by the JSE or the S&P, whatever. To rebalance it as a simple click, click, click. These are now the new constituents and this is their weightings. A portfolio, something completely different. You have to actually trade and manage it towards that particular index, and all of that attracts all sorts of fees, and those fees will, without any sort of enhancement or a way to generate outperformance, simply just going to eat into the realized return of the client, and you're going to end up underwater.
So that kind of feels like my next question you've sort of answered, because it's like, why now? Why portable alpha now?
Yes.
Is it because people are realizing what we've just been talking about?
Yes, I think part of it, two aspects to it. One is market awareness, the fact that pure passive, it's been proliferated, and I think a lot of that is again due to the systematic nature of investing and people understanding that, listen, you could actually just get market returns and they make up the bulk of the realized return quite cost effectively. Mm-hmm. But then you do also want to enhance that return because you have this natural headwind, and therefore an index plus or some aspect of the portfolio needs to have a way of at least offsetting those costs so that net you land up where you intended to be.
And better off.
Exactly. So at worst, at least make up those costs,
yes.
Trading, management fees, whatever. But of course, we're trying to take it further. generate additional outperformance. Yeah.
So in a sense, just to get back to layman's terms, you're trying to marry the beta with the alpha and giving like the perfect solution of the two together.
Correct.
You're trying to just enhance it.
Correct,
Okay.
correct. We often say, I think it's the perfect blend of passive and active investing. In a sense, it takes the good elements of passive investing, which are, low fees, clean market beta, low transaction costs, low tracking error. You have that in the passive market exposure, but then we also have a positive outperformance target in our alpha engine, and it's a better allocation of capital, in the sense that, again, if you are a pure passive investor just simply tracking, the asset allocation decision is taken by the index provider, giving you this is the index that you should track, and as an investment manager, you're paid to put capital to its best use. And with Portable Alpha, the fact that you have this active component in there allows you to do that. So we've got the best of each of these ways of managing money all in one product.
Okay, so now let's get into the alpha itself.
Yes.
What are the sources of the alpha? Because I think of Prescient as a fixed income house.
Yeah.
And now you're talking about passives that could be equity funds, it could be fixed income funds.
Yeah.
There's a whole bunch of ETFs out there, or passives.
Yeah.
So what are your sources of alpha?
Yeah, so you've got it. It's within the cash and fixed income space. That's where we generate our alpha. But there's multiple ways to skin a cat. I mean, there's if you look globally at just general portable alpha strategies, anywhere where you can get reliable outperformance, one that is market neutral, and importantly, uncorrelated to the beta that you have, because
Is that very important?
That is
okay.
That is super important that it's uncorrelated, because from a risk management perspective, if you are getting your beta, let's say from the equity market, top 40, and then you're getting your alpha by also playing within the top 40 market, and then the top 40 market, God forbid, tanks. You're getting smashed on your beta and you're getting smashed on your alpha as well, because they're correlated. That is a scenario that you absolutely do not want that.
Okay.
So they have to be uncorrelated, and the whole risk management through diversification only works if the assets themselves are uncorrelated. So yes, multiple ways to skin it. As long as you have that reliable source of alpha, you can sort of, with a certain amount of degree or certainty, know that you're getting a positive outcome, and you overlay it on top. We like the cash and income space. You sort of said it, and it's one of the things that I'm like, as sitting on the equity side of Prescient, it's one of the things that we're hopefully trying to change, that Prescient is seen as a fixed income manager. We do have a massive equity capability, but we're playing to our strengths. You're quite right in that cash and fixed income has been the historical expertise of the company. It's an asset class that we like quite a lot. It's well behaved. We think it's a very forgiving asset class, and because of that, it's a perfect hunting ground for alpha, as opposed to the equity market.
Okay, and you use the word repeatable alpha quite a few times. Is that with like credit market spreads, or I can just give me an example, just one example of an alpha opportunity that you think is repeatable?
Sure. So, there are multiple risk premia, specific risks that if you take, you are over the long term likely to get paid for. I think an example, again, trying to keep it as simple as possible. Let's say you are putting your cash, you're earning a risk-free rate in a bank account, overnight rate.
Yes.
As soon as you sort of fix that cash, let's say a fixed deposit over 6, 9, 12 months, then immediately you get a premium, because you essentially
time value of money.
Exactly. There's the term premium that you harvest. So, and that is very reliable. Your capital is not at risk. because it's still sitting there. And if for whatever reason you need to actually withdraw that money before the time, cancellation fee will only just eat into the what you've accrued up until that point. So it's quite reliable. If you get it wrong, it's not the end of the world. So that I think is a great example, and one that is very relatable in the sense that everyone understands the benefit of simply just fixing your money in a fixed deposit as opposed to keeping it in an overnight rate and paying for that convenience of its availability.
Okay, so let's talk about portable alpha now in more detail.
Yeah.
The overlay mechanics. How does this, maybe explain again how this all works?
Yes. Happy. I mean, the cornerstone of it, the key to this portable alpha strategy is being able to get that market exposure in an unfunded format. So simplistically, being able to retain exposure to the market without necessarily having to relinquish your cash. And I can give an example here.
So buying a call option on the market or something, or just not putting all your money as a zero coupon bond and having extra coupons and putting the money in. Maybe explain this.
I like your first example. So essentially, let's say you buy a future. Right?
Okay, it's a future, all right.
Or a total return swap, what have you.
Yes.
Essentially, what you have done now is you have secured the future returns of, again, let's say the top 40 index. Top 40 does 10%.
You're going to get 10%.
Does minus 10%. You're also going to get minus 10%.
No, fair enough. Yeah.
But you've signed a contract. The cash that you have in the portfolio is still there for you to utilize.
So you're basically using leverage.
Well, let's talk about leverage. It's
Okay.
not leverage for multiple reasons. In the sense that you're using someone else's balance sheet to fund you, and there will be a cost of funding. But leverage is when you have exposure more than your initial capital, right?
Okay.
But because it's sitting in cash, you are not leveraged in the sense that, let's say the top 40 market goes down 50% down. All you have to do is simply just take 50% and cover that loss. And
you're not worried about margin calls, in other words.
Yes,
you've got the money available
to fund the margin
but you
calls.
aren't putting all the money into the idea. So you can get a return without putting all the money down.
Correct.
That's what you're saying.
Correct.
Okay, now with this extra money that you haven't had to use
Yes.
to buy the index, the
Yes.
beta portion,
Yes.
tell me what you do.
So there is where the active part of this, that's the alpha engine, comes into play. And I already used the example of fixed deposits,
Yes.
but there are multiple ways to skin that particular cat even. So as long as, and then there's specific guidelines that we have depending on the investment vehicle, what have you, but essentially you build up a short-term cash and fixed income portfolio that has a return or that is yielding higher than, remember I said there's a cost of funding on that unfunded exposure.
Yes.
And whatever you get on top of that, that's the pure alpha then that you get on top of your beta exposure.
Okay, so a question, why doesn't everybody do this?
I think everyone, it is done to some extent. It's just that, we're at a place now where I think more and more people are getting to grips with the fact that this is actually what's being done. I think you need specific, obviously, skill sets and also specific type of infrastructure in place to be able to implement this sort of thing. And ultimately as well, I think for most equity managers, their alpha is or their skill set is in picking stocks. And
okay, so for an active manager, they're not interested, but there are plenty of people who sell passive products. Why are they not jumping on the bandwagon here and saying, well, we're going to give you a passive product plus our in-house portable alpha, and we're going to give you the derivative exposure essentially through a futures contract, and then taking that cash that we've got to enhance our returns to do something else with.
Yes.
Why is everyone not doing it? I understand the active guy is not going to do it because that's not his game. His alpha is trying to outperform the passive. Your alpha is saying, we're not going to try and outperform the passive. We're going to create alpha plus the passive that we've got, correct?
Correct, yeah.
So you're not trying to outperform the passive. This does its own thing. You're just trying to create alpha as a fixed alpha opportunity that sits alongside the passive. Is that right? Is that what you're doing?
Correct, exactly. But again, we're trying to outperform ultimately everyone, both active and passive.
No, fair enough. But I'm just saying, the active manager, when I say why isn't everyone doing this, the active, that's not their game.
That's not their game, yes.
That's not their game.
Yeah.
And obviously you're trying to outperform everybody.
Yes, yes.
And it just sounds such a good idea.
Listen, I'm glad.
Okay, so now that I'm thinking this is a great idea,
yes.
the markets are never that easy.
Yeah.
What are the risks?
Yes, so there are several risks involved. It's not a surefire thing. First of all, anything that has the promise of generating outperformance obviously can also underperform. So worst case scenario, you could end up, the alpha engine could end up underwater and actually detracting from the actual market beta. But
okay,
again,
so I'm going to stop you there. So let's go back a step. What would cause it to not be positive alpha? Because you gave the example just now, I kind of lend longer than I borrowed, and I got a spread differential for that.
Right.
And it's probably a lot more complicated than that, but it was just one example.
Yeah.
When has it gone wrong? When has it not worked? Give us a live example where the positive alpha wasn't positive. I mean, the portable alpha, portable alpha wasn't positive.
Yeah, I give you one. I think coming out of COVID, we often got the question, what are the stress tests? And we went through probably the biggest stress test of the strategy, where we had that inflation coming out quite strongly, and then the rates were being raised to combat that quite aggressively. During that period, in our alpha engine, we had quite a portion of that portfolio sitting in fixed rate type instruments.
Oh, so it was fixed versus floating.
Yes.
So your floating rates rose and your fixed rates didn't compensate.
Correct. And then the mark to market, even though, I mean, when you buy a fixed rate instrument, let's say you lock in, make up a number, you lock in 10%, right? But then from that day onwards, rates actually go up, and now all of a sudden the same type of instrument can give you, call it 10.5 or 11%. You get marked down on that particular instrument, right?
Yes, okay.
And because of that, we actually saw the alpha portion start to come back. But again, eventually, we still got our 10%, which was still more than
at the end of the contract, you're always going to get it.
Correct.
It's just a market to market. It's just a timing issue.
Correct.
Okay.
And so that's hopefully an example of how it can go wrong. But I think the beauty that's worth highlighting here is, again, remember, this is within the cash and fixed income space. Like I said, the cash flows are very contractual. So it's not like a equity market where there's nothing really concrete. Here, you know exactly what...
It's not a dividend that you're waiting for.
Exactly. It's not a dividend that could get scrapped.
Yes. It's an interest payment. It's a contract. They have to pay you.
Exactly.
Okay.
Which is why when you do get it wrong, like that, in that instance, the consequences are not nearly as bad as if you had gotten the call between share A and share B wrong.
Yes.
And hence, I said earlier, we think that's the perfect hunting ground for alpha, because it's much more forgiving.
Yes.
It's if you can get away with getting things wrong, as long as your risk management is solid, you can actually get away, and you only risk, again, that marginal gain. Let's not forget, by the way, that there's still the beta component, which makes up,
But you're not responsible for that beta component in a sense. You're not adding alpha to that beta component.
No.
You're adding alpha to the portable alpha component.
No, 100%.
So it's slightly different. I mean, somebody who's buying this product has to understand that the bulk of the returns are coming from the passive. They're saying, I want to be in a passive, but I want to have an enhanced passive return.
Correct.
And I can do it by the portable alpha strategy.
Yes.
So this kind of brings me back to my next question. Who are your clients? Is it institutions who really understand this and dig deep and ask the good questions, or is this the retail public saying, I now buy into passive, it's the only way to go, but I want a better product? Who's your client?
Yeah, so I think this strategy was sort of born out of the institutional space, where you have consultants and sort of for big pension fund that understand the strategy, and therefore know the risks and how it works. But we're also seeing quite a lot, again, on the retail side as well. So your big aggregators, the DFMs, they understand the strategy very, very well. They understand the risks, and they're getting into it. The person, the individual, we're still on that educational campaign to get them to actually understand and buy into the strategy. But it's an ongoing process. But for the most part, we find that institutionals are they're very well versed in this strategy. Your big aggregators in the retail space, they're very well versed in this type of strategy as well. If anything, they will to some extent do it themselves as well, but not outright say it. So having it within one product is actually, we think, a very good thing. And being certain that this is our focus, and being very blunt about that upfront helps everyone sort of know what to expect from this product. We're not fundamental bottom-up stock pickers. This is how we engineer our alpha. Yes, we're playing in the same pool, and ultimately we are competing for the same capital. But we think our strategy is a lot more predictable, reliable, consistent, sustainable.
Yeah, all those good words that we all look for.
Exactly. And the last very good word is very cost effective. So again, from a beta perspective, I know we're not responsible for that, but if you're a fundamental stock picker, you have to make those calls on those individual companies is a very costly exercise, which again gets passed through right to the client, right? That's what you're sending analysts all over the world, kicking the tires on all these companies. We don't do that. So because of that, we can offer this at a much at a cost-effective structure, which also plays hand in hand in the fact that we don't have as big a headwind. So we don't have a 1.5%, 1% return fee or headwind that we.
What are the fees on this?
So on this, we actually price quite TIC on our sort of retail fee class is sort of sitting at around, I think it's about 42, 43 basis points. Okay. So it's not quite as low as passive, but then again, it's not pure passive.
It's not pure passive either.
Exactly, yeah. Okay, but it's towards the lower end of the spectrum.
So weird that we're running out of time, but like if you took this product, Portable Alpha, and it's passive component alongside it. How long has it been running for, the strategy?
Oh, we've been running this strategy for, we've got compasses going all the way back on the top 40, going all the way back to 2004. So
okay.
We have it on multiple betas, right? So
no, fair enough. It's not like it's it's more the Portable Alpha concept as opposed to the beta concept. Because from what you're telling me, it could be on any passive. It doesn't matter which passive it is.
Yes, on any market beta, correct.
Oh, any market beta, yeah. Yes. Sorry, traditional market beta. So if you look at the history of this fund, what has your average Portable Alpha number been?
Yeah.
Is it been 4%, 3%, 5%? What's the number been?
Yeah, sure. So if we
on average.
Yeah, on average, we're looking at around somewhere between 50 and 100 basis points per annum.
Okay.
Again, that's not a radically big number.
Yes.
But the key selling point of that number is that it's reliable, right?
Okay.
So if you're adding, call it 50 basis points to 100 basis points every year, very reliably, imagine what that does over a period of 15 years.
No, it's massive. And also, and is that before fees though? Yeah. So there's maybe 20 bips coming off that or 10 bips coming off that for fees? Because you said 43 bips, but I presume some of those bips are for the passive because it's TIC. Mm-hmm. So how much of your Portable Alpha cost? What's the cost of the Portable Alpha? I'm just trying to figure out what your after fee return is on this Portable Alpha. Yes. So it's 50 bips. Are clients getting 20 or 30? What's the number?
No, so the number I quoted you
is after fees.
Is after fees. So that's the fact sheet number, the number that takes off that TIC, and it comes through in our optimization. So when we set up that cash portfolio, that alpha engine, we set it up with the knowledge back of our heads that we have cost of funding. But we also have to, at least cover the fees. Otherwise, we're just like the passives.
Yeah.
Then we have alpha that is attributable to the client. Yeah.
Okay. Final question for me. I'm just curious: is it possible to have a leveraged version of this? So, if it's so repeatable and so sustainable and so consistent over time, what if I want 200 bips and 300 bips above?
Yeah. Well, listen, we've had.
Do you have clients who come to you and say, "Give us the leveraged version of your Portable Alpha strategy"?
But the funny thing is, they say that. They say, listen, I really like this thing, but can you please jack it up to 4 or 5%? I say, yeah, sure, we can. but then the risk also blows out, right? So there's two sides to any coin.
Yes.
And you're like, no, we don't like that so much.
Okay.
But certainly. I mean, if you are...
Does the holding period just have to increase then for that risk? I mean, you said just now it was a market-to-market issue, so it didn't, it did come right, but you might have had a couple of weeks, months where it was declining.
Sure.
If you were willing to have a longer time period, is that...
Yeah.
Could that work better?
Yeah, it could, but also, I mean, it does mean that you have a more severe...
more severe drawdown.
Exactly, called duration impact.
Yes.
But also, at the same time, the structure is important. So, for instance, within SISCA, Board Notice 90, you can't go beyond certain limits, etc., term limits. But again, there's multiple ways to skin the cat. It might just
today,
mean,
it's 50 bips to 100. That's what this product's doing.
That's what it's done.
It's done.
And again, I have to maybe mention that number is dynamic, right? So when it's flexible. When the environment suits, you could find that, there's a lot more term premium, there's a lot more credit risk premium in the market, and you can actually push that number up without necessarily pushing up the risk so much. So again, everything will start from a risk perspective. As long as the dials are sort of where we want them or within our thresholds from a risk perspective, then we look to the return side. It could be that the return side is very, very attractive.
But that's markets generally.
That's markets generally, yeah.
Anyhow, we're going to have to end it, but thank you very much, Seeiso. I've really enjoyed that. Thank you.
Awesome. Thank you for having me.